It all begins on a warm Friday night in June at a rooftop party in Atlanta. Your friend Darius pulls out his phone and shows you a screenshot of his trading account. The numbers are glowing green, and the balance looks almost too perfect to believe. Forex, he says, almost like he's sharing a secret code. By Sunday evening, you've downloaded a trading platform, created a demo account, and spent hours watching 11 YouTube videos back-to-back. By Wednesday, you've deposited $500 into a live account, money that probably should have gone towards something far more practical. That's how this journey begins for most people. Not with careful research. Not with years of preparation. Just a screenshot at a party. Soon you're paying for trade signals from a Telegram group managed by a man in Dubai whose profile picture shows him standing beside what is almost certainly a rented Ferrari. You subscribe to a trading bot for $140 a month. It advertises consistent 12% monthly returns, but instead, it slowly drains your account balance. You immerse yourself in technical analysis. RSI, MACD, Bollinger Bands, Fibonacci retracements, inside bar formations. Before long, you understand nearly every trading concept imaginable. Everything except how to make money. 14 months later, you've blown 2 trading accounts. Between expensive courses, signal groups, and monthly subscriptions, you've spent nearly $4,000 chasing success. Your demo account performs flawlessly. Your live account looks like a financial disaster. Yet somehow, you refuse to walk away. Whether that's determination or simple stubbornness, you honestly don't know yet. The breakthrough comes the same way most meaningful discoveries do. Not while you're desperately searching for it, but when you're exhausted, frustrated, and almost ready to quit. One evening you stumble across a YouTube video from a trader who looks nothing like the flashy influencers you've been following. There are no Lamborghinis parked behind him. No countdown timers pushing expensive courses. No outrageous promises. He calmly explains liquidity. He describes how price often moves only to collect stop losses before reversing direction. You replay the video 3 separate times. Then you spend hours going back through nearly 2 years of historical charts, searching for the exact pattern he described. Eventually, you find it. 17 months into your trading journey, you commit yourself to 60 days of disciplined execution and structured journaling. Every trade is written down before you enter it. You record exactly why you're taking it. After the trade closes, you document what actually happened instead of what you hoped would happen. At the same time, you begin studying trading psychology. You read the work of Mark Douglas, Jared Tendler, and Brett Steenbarger. Something unexpected begins to change. You sleep better. You argue less. Instead of reacting emotionally, you learn to sit quietly with discomfort. Oddly enough, your girlfriend notices the difference before you do. You seem different lately, she tells you. I've started journaling, you reply. At first, it was only for trading. But somewhere along the way, it became something much bigger. By the 22nd month, 3 important truths have become clear. You spend 2 full weeks backtesting your strategy. Night after night, you sit at your desk while your spreadsheet grows larger with every recorded trade. Hundreds of entries slowly turn into meaningful statistics. When the analysis is finally complete, you realize you've created the most valuable piece of work of your adult life. Your strategy shows a 63% win rate. The average risk-to-reward ratio is 1 minute and 2.4 seconds. The maximum drawdown is only 11%. The numbers prove your edge is real. But one problem remains. You don't have enough capital. The obvious solution seems to be joining a prop trading firm. You've seen countless screenshots online. Traders celebrating funded accounts worth $50,000, $100,000, even $200,000. So you decide to try. Over the next 5 months, you attempt 3 different funding challenges across 2 separate firms. Very quickly, you discover the hidden reality. The daily loss limits constantly clash with the natural drawdown of your strategy. The profit targets create pressure that tempts traders to overtrade. Eventually, you pass a challenge. You receive a funded account. For the next 4 months, you trade consistently. The firm makes money. You receive your payout. It feels like progress, but something still doesn't sit right. The capital isn't yours. The rules aren't yours. The ceiling is obvious, and it's much lower than you want. What you truly want is something different. Real capital, from real investors, given because they trust you, not because you've passed a challenge. Like almost everyone else, you begin with the people closest to you. Your cousin Marcus invests $3,000. Your friend Darius contributes $5,000. 2 more friends add another $8,000 together. For the first time, you're managing someone else's money. Then reality arrives. Marcus asks why his payout seems so small. You explain that a 3% monthly return on $3,000 is only $90. That's when you learn an important lesson. Friends and family aren't bad investors. They're simply the wrong source of long-term growth capital. Not because they lack trust, but because personal relationships become complicated in ways that no legal agreement can completely solve. So you turn toward professional investors. The responses are polite, professional, and almost identical. Your performance metrics are impressive. However, we require a verified trading record. Minimum 12 months. You hear the same message from a family office in Miami, a small hedge fund, a wealth manager in Houston, a private investor based in Chicago. Everyone likes your numbers. No one is willing to invest without proof. So in March, on a Tuesday morning, you create a MIFSbook account. From that moment forward, every single trade is publicly verified. Every entry is time-stamped. Every result is visible. There is nowhere to hide. Nothing can be exaggerated. Nothing can be edited afterward. Only the truth remains. Then you simply trade. The months pass quietly, the way most meaningful years do. Nothing dramatic happens. Your equity curve continues climbing, slowly but consistently. There are 2 months when your account drops nearly 7%. The discomfort is real. But this time, you don't panic. You don't change your strategy. You don't revenge trade. You don't move your stop losses. You don't close positions early out of fear. You simply continue following the system exactly as you designed it. By the 10th month of your verified record, you begin contacting institutions once again. This time your message is short. Only a single paragraph. It contains just 3 things: what you do, how long you've been doing it, and a link to your verified MyFXbook profile. To your surprise, on 11-month verified track record proves far more convincing than you ever expected. The first positive response comes from a family office. Its principal, Dr. Chen, schedules a 45-minute video meeting with you. The conversation isn't filled with flashy promises or impossible expectations. Instead, she asks thoughtful questions. She wants to understand your process, your discipline. Most importantly, she focuses on your losing periods. You pull up the months when your account experienced drawdowns and walk her through every decision you made. You explain why you never abandoned your strategy, why you resisted emotional trading, why protecting consistency mattered more than chasing quick profits. Later, she tells you something you'll never forget. That was the moment I decided you were worth the risk. A few days later, the wire transfer arrives. $1 million. It lands in your account on a Thursday morning. Nothing around you has changed. Your room looks exactly the same. Your desk is still where it has always been. The coffee tastes no different, yet somehow, everything feels different. Over the next 6 weeks, 2 more high-net-worth investors decide to join you. One allocates $300,000. Another commits $700,000. Just like that, you're responsible for managing $2 million. What's surprising isn't the size of the account, it's the fact that nothing changes about the way you trade. You don't invent a new strategy. You don't increase your risk. You don't become reckless simply because the numbers are bigger. You trade exactly as you did when your account held only $500. The same setups, the same rules, the same journal, the same discipline. At the end of your first month managing $2 million, your portfolio finishes with a 3.1% net return. After the agreed profit split, your share is a little over $62,000. You stare at that number for a long time. Not because of what it can buy, but because of what it represents. Proof that the years of struggle meant something. The first luxury purchase isn't a sports car. It isn't an expensive watch. It isn't a designer wardrobe. Instead, you book a business-class flight to Tokyo. During the journey, a glass of Billicart Salmon Blanc de Blancs rests beside you on the tray table. Outside the window, the night sky stretches endlessly. Somewhere over the clouds, your thoughts drift back to that rooftop party in Atlanta. Back to Darius. Back to the screenshot that started everything. Tokyo turns out to be exactly what you hoped it would be. Orderly. Precise. Calm. Every detail seems intentional. You stay at the Aman Tokyo, occupying a room on the 33rd floor overlooking the Imperial Palace Gardens. One evening, you sit at a tiny sushi counter in Ginza. There are only 8 seats. The chef has spent 31 years perfecting his craft. As you watch him work, something becomes clear. His mastery wasn't built overnight. It was shaped through thousands of repetitions. Daily refinement. Patient consistency. You recognize the same principle in your own journey. Different profession. Same process. When you return home, you continue expanding. By the end of your second year managing outside capital, your assets under management exceed $8 million. Life looks very different now. The apartment has become a penthouse. There's a rooftop pool. The skyline outside your windows needs no filters or editing. Parked downstairs is a dark navy Porsche 911. Not because you wanted to impress strangers, simply because you genuinely enjoy driving it. In May, you spend a week in Monaco, watching the Grand Prix from a hospitality suite overlooking the harbor. The roar of the Formula One cars isn't just something you hear. You feel it vibrating through your chest. Below, the Mediterranean stretches into the distance. Calm, blue, and almost impossibly beautiful. A few months later, in September, you travel to the Amalfi Coast. One evening you enjoy dinner on a terrace carved into the cliffs above the sea. The white tablecloth is perfectly pressed. The local wine complements the evening. The entire moment feels too meaningful to capture with a camera. Some experiences are simply meant to be lived. None of it arrived by luck. None of it was handed to you. Every single piece of this life was purchased with a different kind of currency. The blown trading accounts, the expensive telegram signals, the restrictive prop firm rules, the uncomfortable conversations with investors, the painful drawdown months. Each setback quietly paid for everything that followed. There's another version of this story, one where you quit after 14 months. Most people do. Not because you're more talented than they are, but because you stayed with the discomfort long enough for it to teach you something. Eventually, that discomfort became data. The data became a strategy. The strategy became a verified track record. The track record attracted capital, and that capital created an entirely new life. The market has never cared who you are. It doesn't reward confidence. It doesn't reward hope. It rewards only one thing: a genuine edge. Proven, repeated, and managed with discipline. You learned that lesson the difficult way, and perhaps that's the only way lessons like this ever truly last.